very good morning to everyone and a warm welcome to one and all who have joined us today. I'm Tasneem and I'm the moderator for the session. Thank you so much for joining us on a Saturday morning. Fundsindia welcomes you all to the webinar, and our today's topic of discussion is why have debt funds become volatile? What is the way forward? So we have a research head, Mr. Arun, who will be heading this session. So over to you, Arun.
Yeah, thank you so much, everyone. Thank you so much for joining us. Today, this is a topic which is probably in the top of the mind for a lot of us. Earlier, it was equity, but right now, suddenly, most of you would have realized that starting the second week of January till date, the debt funds returns have also been slightly on the slightly more volatile than what we normally see. So the basic idea behind this overall presentation is to give you a glimpse of what is happening in debt funds. And because of what happened a year back in terms of lot of credit risk and all that, usually whenever there is some bit of volatility in debt funds, there's always this worry that is something going wrong on with my debt fund, should we act immediately? So these concerns are perfectly valid. So the idea here would be that can we give you a perspective in terms of what really goes behind the debt return? So every time you see your debt returns as whatever the number, let's say let it be 0.5% or minus 0.2% or 0.3%, what really happens? Which are the contributors to these numbers, and when should we be worried and when should we not be worried? So that's the overall context in terms of can we put some context behind these numbers so that you will be in a much better position to take a clear decision in terms of one, what is happening on debt funds, and also to get a perspective on what to expect from debt funds going forward. So that's the broad agenda of this meeting. Maybe I'll take around half an hour, and post that we can open it up for questions. So first, let me essentially start with the just Yeah. So first, let me begin with the basic part of debt fund. So before we actually delve into why is it become volatile and all that, I wanted to take a step back and give you a sense of what is debt fund investing actually about. When we say debt fund investing, the first frame that we all think is that we are investing money. But if you really think through the basics, in debt funds, whenever we invest money, what we are essentially doing is we are actually indirectly lending our money. So what really happens is every time you invest, let's say 10,000 rupees into a debt fund, you are actually not investing, but you are actually indirectly lending your money. Now, why are we lending our money? Because what really happens is that uh, in essence, debt funds collect money from us and lend it to a group of either corporate companies, banks, NBFCs, or the government. And in turn, for borrowing the money indirectly from us, the corporates, the government, or the banking companies, they provide us with a particular interest rate. And for whatever is the period that they are borrowing from us, post that they return the money back. Now, obviously, if we have to do it on our own, we do not have the bandwidth to analyze which is the company which can give us better interest rate, which is the company which is a good quality. So all that we won't be able to do it at our end. So basically, debt mutual funds are in essence intermediaries. So net what happens when we invest money in whatever be the debt fund is simply that the debt fund takes money from us and lends it to a group of companies or the government, right? So net let's assume that, so let's simplify the whole thing. If whenever we are lending our money, let's assume a friend of ours comes to us and then ask for money. The first question that we will have is that is he a reliable person? Will he give my money back? So let's say a friend of mine asks me for, let's say, 10 lakhs as a loan. The first question that will come to me is that will this fellow return the 10 lakhs to me? Now leave the interest rate, that is the second prerogative. The first thing is he reliable? Does he have a stable job? Does he have a stable salary? Will he be able to return the money back? So that's exactly what got into attention the last year for debt funds, because there were a lot of funds which went through the some of the credit risk. Credit risk is nothing but if the debt fund lends to, let's say, 10 or up to 50 or 100 companies, and some of these companies, if they are not of the highest quality, they can probably they might default if the economic environment goes a little bad. Now you might ask, saying that why in the world would a debt fund want to lend to a company which doesn't have the best quality in terms of different parameters. Now the simple reason is that if you are a borrower and you didn't have a highest quality parameters, you will obviously pay a higher interest rate to borrow. Just like how if you go to a local money lender to borrow, the money lender will obviously charge you far higher interest rates compared to if you have proper documentation and you go to a bank, you will get it at a much lower rate. But obviously people who go to money lenders usually don't have the required documentation, and hence they become high risk assets for the money lender as well, and thereby the money lender charges a higher interest. So this is just a simple normal commonsensical thing that happens everywhere. So some debt funds take the call that I will be able to evaluate the companies better. So while the company's credentials look a little weak according to the rating agencies, but I have done my own due diligence and I know that these guys won't default, and hence I am lending to the companies to get a slightly higher interest rate. So this is the first leg. So how can we look at that number for debt mutual funds? These rating agencies give ratings. So if it is AAA and equivalent or AAA or government related securities predominantly are considered to be the safest. If you look at most of our select funds, it will predominantly be 100% AAA and equivalent kind of securities, and a few of them to give you a slight higher kicker in returns might have up to 80 or 90% in AAA, with the remaining 10-20% also in very high qualities, but probably in the second slightly lower, the second quality, maybe AA plus would be the second highest quality coming from the top. So that's how we design and select our funds. So first leg is we are done with evaluating the quality, and then the next question that we will naturally ask is, what is the interest rate that these companies are giving to me? So underlying aggregate, if my debt funds is giving loaning it out to let's say 50 companies or 60 companies, what is the underlying interest rate that those companies are paying? And that should ideally be my returns, right? Because net I am lending my money and somebody is paying me interest, and the debt funds are an intermediary. Now this number in debt market parlance as to what is the interest rate is called as the YTM. While it might sound very complicated, it's called yield to maturity. In simple terms, it is like whenever you go and buy and lend your money to a bank in terms of an FD, there is an FD rate, right? So today the FD rates for SBI might be somewhere around 5%. So that is your interest rate that you're getting. So similarly, in debt market parlance, whenever you are lending your money to the debt fund and the debt fund is lending the money to several companies and the government, the aggregate interest rate that the government or the corporates which are borrowing from you are paying you is called the YTM. Okay. Now, obviously, debt funds don't do this for free, right? Because they put a fund manager, there are a lot of analysts, they have a lot of advertisement costs, they have to run the whole mutual fund, all the other operational expenses, the regulatory compliances. So for this, they also need to get compensated, and hence they charge something called the expense ratio. This might be somewhere close to 0.2, 0.3, 0.4, 0.5%, or up to 1% is where most of the debt funds will predominantly be in the range of, let's say, 0.3% to 1%, depending on different funds will charge a different expense ratio based on the underlying strategy of the fund. So net, the first simple thing that we should look at is, for any debt fund, the key is to not look at the past returns, because let's say you got FD returns of maybe 7%, 8% in the last 3 years. But if you are investing now into an FD, you will naturally look at the current rates. If somebody says that last 3 years FD gave you 8% and next 3 years, you will obviously say that no, but right now the interest rates are at 5%. So roughly my FD returns would be close to around that 5%. Similarly, in debt funds, while the past returns, while you look for most of these funds might be around 8%, 9%, and even 10% in few cases, the key thing to remember is that do not go by past returns when you are investing in debt funds. As simple as how we invest in FDs, the first thing is to go by what is my YTM and what is the expense ratio that my fund charges. Now, if I subtract the YTM from my expense ratio, I roughly get to what I should expect from my debt funds over the next 1 year. Okay, so this is called the net YTM. It might sound like a jargon, but it is fairly simple. Net YTM is nothing but the YTM minus your expense ratio, and these are publicly available data. So for any fund, if you type the fund's name, you will automatically get the YTM and expense ratio. These are disclosed on a month-on-month basis. So there is absolutely no issue in terms of finding these numbers for any fund that you want. Now the key point is that, so now that we know it for a 1 year basis, but ideally we see volatility on a 1 month basis sometimes, and so it is easier to evaluate or set expectations on a 1 month basis, so that we roughly kind of know saying what is happening. So let's assume my net YTM of a fund is, let's say, 6%. So which means that on a yearly basis I will get roughly around 6% returns. So on a monthly basis, how much will I get? It's simple mathematics, which is nothing but 1 year is 12 months. So if you divide by 1 year returns is 6%. So for 1 month, you divide it by 12, you will roughly come to around 0.5%. Now, most of the funds are right now are giving net YTMs of somewhere close to 4 to 5%, which means that your return expectation on a 1 month basis from your debt fund should be roughly around 0.33% to 0.4% per month. Okay, this is and this net YTM will be different for different funds. Now you can plug in your particular fund's net YTM. Just take a calculator or take your mobile phone, divide it by 12, and this is the rough expectation that you should expect from your debt mutual fund. Now let's look at a practical example of, is this the right way to look at it? Okay. The other way also to think through this is that, think of your debt fund returns as a mountain climber who's climbing a mountain, and each and every step he takes, so one step is equal to 1 month return. So there is 12 months, 1 year return will be equivalent to 12 steps, and each and every step is going to be the net YTM divided by 12. So you consider this to be net YTM divided by 12, which is nothing but the number that we calculated here. Okay, so very simple. All your debt funds, the bare minimal, the first starting point of expectation should be that, what is the one step of mine equivalent to, and that is simple, net YTM divided by 12, which will be your. So let's take a practical example saying that, does this actually take place in reality? Because till now it sounds fair enough, it sounds logical, but again we have to test it against real life, saying that, does this work? Okay, now what I've done is I've taken HDFC short-term fund as a sample. You can take any fund for that matter. This should ideally hold true for all the funds that we are showing. Right now, if you look at it, you will see that we have taken the last 6 months just to give you a sample. Okay, in September the net YTM was 5.5%. So the expected monthly return was simply 5.5% divided by 0.46%. So which would roughly 5.5% divided by 12, which would be around 0.46%. Similarly, in October it was 5.46, and then you divide it by 12. This should be your monthly expectation. Now if you see this is fairly stable, right? If you look at the last 6 months, the YTMs have been somewhere between 4.7% to 5.5%, and you can see that your returns should have ideally been pretty stable between let's say 0.4% to 0.46%. Right now, let's look at what really happened. Okay, the first month 0.46% and actual returns were pretty much close to each other. So our logic held true. But in the second month, if you look at it in October, while we were expecting only 0.46%, because the underlying interest rate was only indicating 0.4, suddenly you had a huge kicker in return. You almost got thrice the return for that particular month. Okay. Similarly, if you look at Jan 21, you were expecting somewhere close to 0.4%, but you only got you got a flat return, or almost a slight negative return. And similarly, last month, which is February, where you would have expected 0.4 return, you actually made a minus 0.5% return. Now there is some disconnect, right? So we said that, hey, the underlying guys are giving me an interest rate which will roughly amount to this, and this is supposed to be stable, and this is what I expect. But there are months where it's working close to the original number, like in December 20 and September 20. But in October and November, it was far higher. It gave me like significantly higher returns. But similarly, in Jan and 20, it's giving me significantly lower returns. Now what is happening? Why is there this gap between what my underlying borrowers are paying me vis-a-vis what I am actually getting in debt fund. This is where the real confusion happens. Now, if it's the higher number, right? A lot of us don't ask the question saying, I am supposed to get only 0.5%. Why am I getting 1.3%? Because it's a positive number. We don't mind it. We are happy with it. But when this happens, right, in February, when it is supposed to be 0.4, it comes at minus 0.5, we get a little worried. Hey, what is happening? Is something going wrong? Now, the key point is there is the second component, which we haven't discussed in the first part, which is simply that you see, we only saw this particular portion in the first go. Just give me a second. Yeah. So if you really look at it, there is the second part of the same equation, which is nothing but the rate at which the interest rates or the yields keep moving. Now, whenever yields move up, right? Whenever yields move up, what happens is that there is a small this rope is loosened, and then there is a small slide. So which means that you are taking one step up, but the fact is that because the interest rates are moving up, you slide a little down. But if the interest rates are going up, you take one step up, and the rope is also pulling you up, giving you some excess returns. Now, why? What is the logic behind it? So the way to think about it is simple. Whenever interest rates are moving up, your returns will be slightly lower than what your actual one step returns would have been. Like you have taken one step, but the rope has given a slide to you, and hence your returns are slightly lower. Now, if in the other case, if interest rates came down, you had the one step of returns, which was nothing but the 0.33 or 0.4%, which you are normally expecting for HDFC short term. And on top of it, you got an extra kicker because the rope was pulling you up, which was nothing but the interest rates going down. Now, so the simple thing to remember is, first is you go look at the net YTM. You will get the monthly approximate return to be expected. And then the next question that you ask is the interest rates going up or is the interest rates going down? If the interest rates are staying at flat, then you will roughly make up for the 1 month return that you expected. But if the interest rates are going down, it's super good because you will get far excess returns. But if the interest rates are moving up, then you will get a slightly lower return. So you would have made the one step ahead, but the point is the rope is again pulled you down because your interest rates went up. Now you might ask, what is the logic behind this? Now the logic behind this is very simple. Think about it as an FD that you have bought. So let's say you bought an FD for 5%. Okay. Now you've locked in the rate for 5% for the next 5 years. And after a year, you are desperately in need of that money, but the bank says that you cannot give it back to me because it's a 5-year FD for some reason. Just assume that this is a hypothetical example, and hence, just like how bond funds are traded, assume a hypothetical bond world where you could also trade your FD. So let's say I have my 5-year FD, which is completed. Argument sake, let's say it is completed 2 years. Now it is a 3-year FD, which again is stuck at that 5% rate at which I have already locked. But let's say 2 years down the line, the interest rates at that juncture have increased and are at 7%. Now you are not able to, let's say you want to trade it with a friend of yours saying that you need the urgent money back. And then you go to your friend and you say that, hey, I have an FD which pays a 5% interest rate. Can you buy it from me? Now the friend would obviously tell you that, hey Arun, right now all the banks are giving me 7% interest rate. So obviously I won't buy it from you at 5% interest rate. The only so if you provide me a 7% interest rate, I will be able to buy it from you. So how in the world can you provide a 7% interest rate? Because your underlying interest is interest amount that you get every year is fixed, right? So what you do is you say that, okay, I'll take a cut on my price, so you give me a lower value, so that net the underlying amount that comes will compensate for the will net work out for a 7% interest rate for you. So you pay me a lower amount, I will take a cut in my original value. So the key idea is that if you're locking it at 5% and your interest rate goes up, then what it simply means is that your FD's value is coming down because you have locked in for 5%, and after 2 years it's become 7%. So the current FDs are more attractive than you, and hence your value will come down, which is exactly the slide that happens because your interest rates have moved up. In the other case, let's say if instead of 5% for some reason FD rates became 3%, then your FDs become very attractive because the entire market is giving only 3% interest rates while your FD is at 5%. So you go to a friend and then now you ask for a better rate, saying that, hey, mine is giving you 5%. So why in the world would I give you 5% at the normal price? So you give me a higher price than what I bought so that I will pass on my FD. So this is the rough way to think through it, which is why whenever interest rates go down, you will have a positive impact on your debt funds. And whenever interest rates go up, you will have a negative impact on your debt funds. So these are two things to remember. What is my underlying interest rates coming from the group of borrowers, which is nothing but your net YTM. And the second is my interest rates going up, which if it goes up, then my returns will be lower. If it goes down, then my returns will be in excess. So these are the simple two things to remember. Now the next question is, if my interest rates are going up or going down, what will be the extent of impact? Now see, 1% interest rates might go up or go down, but what will be the extent of impact on my funds? How do I calculate that? There is this number called modified duration, which is again provided in all these in all the fund fact sheets. If you look at the modified duration, one second. Yeah. So what the modified duration basically says is that whatever is the change in yields or whatever is the change in interest rates, this number will indicate by what degree that change in yields gets multiplied by. Now the modified duration for something like liquid funds might be very low, or something like gilt funds might be as high as 8 or 10. So what it simply means is that if there is a 1% move in yields and your fund's modified duration is 8, then it will multiply it by 8. So there'll be an 8% impact. It can be positive or negative based on which side your yields are moving. If it is going down, then you will get a huge positive impact. And if it is going up, you will get a huge negative impact. So the key number to watch out for is modified duration, because the higher the modified duration, the higher it will magnify the impact of your yields. Okay. So in essence, if yields are going up, it is negative for bonds. If yields are coming down, it is positive for bonds. So roughly, if you have to put this whole thing through a simple equation, think about it like a seesaw. Okay. On the left hand side, you have the change in yields. So when yields go up, you will have a negative impact, and when yields come down, you will have a positive impact. So for all your debt funds, you start with the net YTM portion here, and then you divide it by 12, you will get the monthly return for your debt fund. So that is your first starting point. And then you see if in that particular month has my yields gone up or gone down. If they go up, then you will get a net YTM by 12 minus of your modified duration into whatever is the change in yields. Okay, so this is how. So what really happens in debt funds is that if you think the yields are going down, then you will have to go into funds which have a higher modified duration. So that's why you will suddenly see gilt funds, income funds do really well in the last if you look at the period any time during the last year, if you see the past returns of these funds, it will be dramatically higher, because all these funds run a modified duration somewhere around 6, 7, 10, 11, 12. The modified duration is very high. So even for 1% interest rates going down, you will multiply it by 6 or 7. That will give you a kicker of almost 6% on top of your original returns which you are getting. But if the reverse happens, then the higher modified duration funds will also get dramatically impacted with the higher impact on their NAVs. So the whole idea is that, so if your modified duration is very low, then whatever is the interest rate change, the impact will be hardly very, very minuscule. But if your modified duration is very high, you might either get a huge return kicker or you might get a huge return detractor. So which is why the number called modified duration is very, very important for all your funds. So this is the most important number that you should be aware of for all the debt funds that you're investing. And you should also have a view on what is going to happen to my yields over the next 1 or 2 years. Roughly, you obviously none of us can precisely predict whether it will go down or go up, but there will always be signs where we can roughly take a guess on what can happen. So this is as far as debt funds are concerned. If you get this right, we can more or less get the whole thing sorted. And And now let's go back to our original example that we saw, where we saw that for HDFC short term fund, how did the returns pan out? We have taken the same 6 months. This was the net YTM that we are showing. We divided it by 12. So roughly my expectation was somewhere close to around 0.4 to 0.45%, but the actual returns were differing for a lot of months. So let's take this particular month where I was only expecting 0.46% in October, but my returns was 1.3%. Now, where did the return kicker come in? Now, this is where this whole idea of modified duration comes in, because HDFC short term runs a modified duration of 2.7. Now, the key is, what is my change in interest rates? Now, as I told you, if the interest rates are going down, we will get a kicker in returns. The good thing was interest rates went down. So interest rates went down by 0.3% in October. So which means you multiply 2.77 into zero point 0.3, you will get an overall impact of 0.86%. Because it is a fall in interest rates, the seesaw moves up on the other side, and hence it's a positive impact. So net you add 0.6 and 0.46, which was your original underlying interest rate, and you add the component from the interest rate changes, you net you come around 1.31%, which is pretty much close to your actual return. So why did we get higher returns? It was not anything to do with magic or anything. It's simple that interest rates were falling down. November, again interest rates fell down, you made a higher returns. December, interest rates did not fall down much, they were more or less flat. So you net ended up making return which was very close to the original underlying interest rates or the original net YTM. Similarly, in September, hardly any change in yields, and you more or less made the original return of 0.46%. And now the key point is, what happened in Jan and Feb? Why are my returns down? So by now you would have guessed it. Simply the interest rate should have gone up. So which means it detracted from my 0.4 or 0.4% or 0.38% returns. So in October, November, we were on the positive side because we benefited. But in Jan, February, the same thing is cutting back against us. Now what happened? In February, especially, there was an interest rate hike or base, not interest rate hike, but the yields had gone up by close to around 0.35%. In Jan, they had gone up by close to around 0.17%. And because of which, there was a negative impact. February was very stark, almost a 0.9% impact, because this 0.35% gets multiplied by 2.5 times, which is your modified duration. And net you add both, you come to the minus 0.49% returns. So the key thing to remember is that the reason why your debt funds have become suddenly volatile is not because something has gone wrong with respect to the credit part of it, credit quality part of it. The underlying borrowers continue to be very good, stable, and they continue to provide their they continue to pay their interest normally. There is absolutely no concern on that. It is simply that in the system the yields are moving up. Now the next question is, why are the yields moving up? So I'll address it at some point at a later point in time. But broadly, this is the 10-year one. Okay, so this is the 10-year chart, and 10-year yields of Indian government borrowing. So you can see that this is the rate at which Indian government borrowed for 10 years at different interest rates, right? Based on the period. So you can always see that there's a period where interest rates fall, and during this period, debt funds will do really well. There's a period where interest rates go up, where debt funds might not have too much of advantage, and during these periods you essentially need to be in funds which are of lower modified duration. Similarly, when it goes down, you need to if you have a higher modified duration, you get a huge kicker. So you can see that there is debt fund cycles. There is down, there is up, there is down. So last few years was a down cycle, which means that all debt funds benefited significantly, almost from 8 plus we went close to around 6. So there is almost a 2% fall in interest rates in interest rates. So which meant that all debt funds had benefited from it. So over a cycle, there will be a period where debt funds might have lower returns, and there'll be a period where debt funds will have excess returns. Net, which is why over a 3, 4, 5-year period, debt funds end up giving you significantly better returns over an FD. But again, you have to remember that it will include a component of a period where debt funds are also not performing well because of the fact that interest rates are moving up. Same thing happens on the 1 year GSEC as well. You can see the same pattern following, that it will go down, it will go up, it will again go down. So these are interest rate cycle. So it's very important to know where we are in the interest rate cycle, right? So now the key point for us is, we by now we realize that if yields are going to move up, then our debt funds might get impacted. Especially the impact will be far higher if my modified duration is a very large number. So what we have usually done is, we have generally stuck to nothing more than a modified duration of 3 years. Why? Because we have realized that over a long period of time, 2 to 3 year modified duration funds with very high credit quality, which is nothing but the companies lend to are super high quality, tend to do really well over market cycles. But if somebody entering now, even the 2 to 3 year might also give you a slightly more volatility, and hence it is better to go for the lower modified duration funds. Now the key point is, we have to figure out saying where are we in the cycle. Now if it is a down cycle, we can still afford to be at a 2 to 3 years. Some people might want to take it to 6, 7 and all that. Those can be tactical calls, but broadly on a core basis, a 2 to 3 year segment usually works well across the time frames without needing to time these cycles. But the broad idea is, what is happening right now? Why are the yields going up? Okay. Now, why did the yield suddenly start to inch up after Jan 8th? Jan 8th, RBI came up with some measures to remove the liquidity. Liquidity simply means that the amount of, in very simplistic terms, it's the amount of money available with the banks where they are. So, which means the larger the amount of money available with the banks, the more they can lend. But in essence, it meant that the banks were not willing to lend. And the idea of the RBI during the crisis was to make sure that banks have enough money kept, so that they will be able to lend to people at a time when there was a crisis. So RBI did a lot of these liquidity measures, which is why you see that the liquid fund returns are all very, very, very low compared to historical standards. So RBI did some measures in Jan 8th, where they wanted to, where they basically signaled saying that we might slowly want to remove all these measures because the economy looks like it's gradually picking up and coming out of the real problem. So we can't continue with those very exceptional measures that we took during a crisis period. So that is when bond market got spooked. Then they thought that, okay, this is going to signal yields moving up kind of an environment, and hence you first saw that a lot of these yields started moving up, thinking that RBI will eventually be taking off all these liquidity measures, which meant that the yields will go up. So this was the first. It was started off very innocently, but even RBI didn't expect that the bond markets would react in such a shocked manner. But the real killer came during the budget announcement, when the government came and said that, hey, we are going to spend a lot to revive the economy, especially on the infrastructure, which also means that I will have to borrow a lot more than what is usually considered normal. So which means that obviously I'll come to the bond markets to borrow, and the number was somewhere close to 12 lakh crores. To put that in context, a year back before the COVID, the rough borrowing numbers were 7.8 lakh crores. So it is almost like 50% higher than what was the pre-COVID expectations of the borrowing. So even last year, while they said 7.8 lakh crores, last year also the number shot up to 12.8 lakh crores. And this year is again 12 lakh crores. And the government has clearly told that we will continue to spend at least for the next 4 years. So which means that there's a large borrowing program coming, and hence then the bond markets were spooked completely, because this means that government is going to borrow such a large number. And hence obviously if somebody is going to borrow a large amount of money, then it also means that on the other side, if you and I have to lend money and we know for sure that government is going to borrow such a number, we'll obviously want a higher interest rate. So that is when the yield started spiking far more higher. And that's why you saw that in February most of the yields had gone up by close to 30, 40 bips for most of the funds. Okay. The other problem was that the global yields have also increased globally, be it US or Europe. All the countries, the yields have gone up. Why? Because most of the countries are looking at an economy which is going to recover, and there's also been a lot of fiscal stimulus which has been given by the government, and hence there's a concern that inflation might slightly inch up, and hence the global yields have gone up. And again, as I told you, RBI had started to take back a lot of those excess liquidity measures that they've announced. So they've clearly told that gradually we will be removing them. And then in India also there's inflation worries because the commodity prices have gone up. All of you would have noticed petrol prices. And then again, as and when the economy recovers, there's always be a sudden increase in demand. So that might also lead to some. So these are the four worries on one end, which is pushing the yields up. The ideally it would have, if only these four conditions were there, the yields would have shot up far more higher. But there's one more person who wants the yields to stay down, which is nothing but the RBI governor, because in essence, if yields move up, the government won't be able to borrow such a large number, because if instead of 6%, if it goes to 6.5%, then it's an additional 0.5% cost for the government. So RBI will try everything possible to make sure that the yields don't dramatically shoot up and in a very sudden manner. So RBI has time and again come and communicated saying that we will ensure that we will keep this whole yield increase whenever that happens at a more gradual pace, and we will try to manage it as far as possible. While obviously we are not as strong as the developed central bankers, but still, whenever a central banker gives an explicit communication that we will attempt to make sure there is no disruption in terms of the yields. So this is again a strong force. So there is a tug of war between these two forces. But the broad sense that we are getting is that we are looking at a period where the yields are going to rise. And the key point is, but it won't be very sharp like what we saw in February or January, but it'll be more gradual. And so net, the key point is that in an environment where the yields are expected to rise over the next 1.5 years, you will definitely have to be prepared for slightly more volatility in your debt fund returns, especially if you have higher modified duration funds. So the extent of volatility to be expected will depend on the underlying modified duration of your fund. So net, we think all the new portfolios which are entering right now, they'll have to be positioned for a rising yield environment. Now, why do we think that the whole thing will be like much more gradual and not sudden? The reason is because of RBI, because RBI is clear that they will do whatever it takes to ensure that this whole yield increase is not very sharp and there is no shock to the system because of that, because then it will completely derail the economic recovery plans of the government and also the borrowing plans of the government. So net, it will be a tug of war, and our basic thought process is that yields will increase, or will most likely, there is a high likelihood that yields will gradually inch up. But the point is, it will be a lot more gradual. So the key word is gradual, and we don't think something like February, where there was a very sharp spike in yields, that can repeat. So ideally, our sense is that more or less most of the sharp increase is already behind us, and we will most likely look at a lot gradual increase in yields. But the important point is it will be a gradual yield increasing environment. So in this environment, for new funds which are getting deployed, it's key to remember that it's better to have a slightly longer time frame and to stick to funds where the modified duration is on the lower end. So you can predominantly stick to money market, low duration or ultra short term funds if your time frame is less than 2 years. Or if you have a 2 to 4 years, you can split it into a mix of 50 to 100% into the money market, low duration, ultra short term. And if you're okay with some bit of volatility for the next 1 year, but you're okay with returns coming in the second and third year, you can also add short term or corporate bond funds or banking in PSU. If you have something above 4 years, you can reduce the component of the less than 1 year bucket, which is money market, low duration and ultra short term, and you can increase the bucket in short term corporate bond funds, banking and PSU. But you also need to remember that in the near term, the returns might be slightly more volatile compared to the less than 1 year bucket. So the broad idea is that there is absolutely nothing to worry because all our funds are super high credit quality. The only thing is that, and we have always stuck to a modified duration range of nothing more than 3, because we've always believed and we have seen that over cycles, this is the category which does really well with far lower volatility. And we are not big fans of going into gilt and then trying to time it, and which were, so we would have written, even in fact we wrote a blog post like 3 months back when there was tremendous pull towards these kind of gilt funds. Our basic call was that the risk is too high there, and we will predominantly stick to a narrow band, and we will try to play around with it. So for incremental money, you would have to take a call saying if you don't want volatility, you have to stick to the less than 1 year bucket, where the volatility will be very, very minuscule. But again, the returns for the next 1 year will have to be on the slightly lower side in terms of expectation. But again, at some point in time, when yields pick up and then you get better yields, again there will be time when debt funds will continue to do extremely well. So it's a part of the cycle. The cycle where we did really well was the last 2 years, and again there'll be a 1 year where we will have to we don't need to do anything fancy to improve our returns. This is a time where we'll have to be okay with slightly normal type of returns, and then we'll again get an opportunity where we can again go and have do some new strategies to improve returns. But the key thing to remember is that volatility might be here to stay, and most importantly, please understand that it is a reflection of the modified duration of your funds. So there is nothing going wrong with the fund per se. So that is the key which I wanted to communicate for today. So thank you so much for joining us on a Saturday. Thank you so much, and see you all the next